My fellow investors, fellow Jamaicans, welcome back to the Monitor JA channel. And today, we are diving deep into the latest financial powerhouse report coming out of the Caribbean. Scotia Group Jamaica has officially released its results for the first quarter of fiscal 2026. In a climate where every percentage point matters, the group has posted a solid net income of $4.1 billion for the 3-month period ending January 31st, 2026. While this figure represents a marginal 2% decline compared to the $4.2 billion recorded in the same quarter last year, the underlying data suggests a bank that is actually expanding its footprint. In fact, total revenues saw a significant boost, climbing 9.7% to reach $18.8 billion. This growth was largely propelled by a surge in interest income, which hit $14.1 billion, an 11.4% increase year over year. President and CEO Audrey Tugwell Henry noted that this performance comes despite a challenging macroeconomic backdrop, including the lingering recovery efforts following Hurricane Melissa. The bank's ability to maintain high profit levels while absorbing increased operational costs and a higher provision for credit losses shows a high level of balance sheet discipline. One of the most striking parts of this report is the growth in the retail sector. Scotia Plan loans grew by 16%, proving that consumer demand for credit remains high. Even more impressive was the mortgage portfolio, which expanded by 19%. This suggests that despite global interest rate fluctuations, the Jamaican real estate market remains a primary focus for the bank's capital. On the deposit side, the public's trust in the Scotiabank brand remains unshaken. Total deposits from customers grew by 11.5%, now sitting at a massive $547.6 billion. This influx of cash provides the group with a very healthy liquidity position, allowing them to continue aggressive lending in both the consumer and commercial spaces. The commercial banking segment is also seeing a digital revolution. Commercial deposits grew by 12% as more business clients transitioned to the bank's digital platforms for their daily operations. This shift is a win-win as it lowers the cost of transactions for the bank while providing more convenience and security for the business owners. Scotia Investments and Scotia Insurance also played their part in the Q1 success story. Asset management fees remained stable, and the insurance arm saw a steady uptick in policy renewals. This diversification of income is what allows the group to remain profitable even when one specific sector faces temporary headwinds. Looking at the balance sheet, the group's total assets now have reached a staggering $818.8 billion, up from $725.6 billion just 1 year ago. That is a 12.8% increase in total size. For the investors, the board of directors has approved a first interim dividend of 45 cents per stock unit payable on April 14, 2026 to stockholders on record as of March 23rd. So, the takeaway? Scotia Group Jamaica is leaning into its Reach Higher strategy. They are growing their loan book, expanding their digital footprint, and maintaining a massive capital cushion. While the net income had a slight dip due to higher expenses and environmental factors, the revenue growth proved that the engine of the bank is running even hotter. So now it's over to you guys. Tell me, what do you think of Scotia Jamaica's Q1 2026 results? Drop your thoughts in the comments below. And before you go, my fellow investors, quick update. Money Talk JA now has a newsletter. Hit the link at the top of the description to sign up to join our growing community and make sure that you never miss an update. Thank you for watching, and click the link on screen now to watch another Jamaican financial content. Catch you in the next one.